Happy Wednesday.
Happy Wednesday. We're in the middle of the week. Yeah, I'm super excited today. For those of us who are, well, not those of us, all of us are probably in this time of just getting our tax stuff together. So it was really important for us to have this presentation, talk about some of the deductions that you can take last minute, especially for business owners. I think this is going to be a great hot topic. So we'll go ahead and get started. And before we do, we just want to tell you a little bit about ourselves. Go ahead, Mr. Matthews.
Yeah, everybody, my name is Jason Matthews. I'm president and CEO of Matthews Financial Insurance Solutions. I've been in the financial services field since 2004. Wow, it seems like I'm approaching 20 years, but I'm still so young. But what we do is we specialize in tax strategies, retirement planning. We're here in Oakland, California, but we can serve anybody across the nation. And I tell everybody where I specializes in is working with people who come across a windfall of money, either through an inheritance, settlement, switch jobs, or decide to retire.
Absolutely. Hello, everybody. My name is Thandiwe Cato. I'm a financial advisor at Matthews Financial and Insurance Solutions here in Oakland, California. Like Jason said, we work nationwide, and especially in this virtual world, we're able to connect with different people. So if you're here from a different state or a different city, we would love to work with you. There was definitely the opportunity to help people on their financial journey. So for this topic in particular, it's really going to pertain to folks who are self-employed, small business owners, and helping them take advantage of some of those tax deductions that we're going to be talking about today.
Yeah, so definitely.
So we're going to go ahead and just talk about some due dates that are coming up. So the first one just being, and I put that wrong. It's supposed to say Medicare enrollment deadline, which is tomorrow. So if you haven't already, make sure you've done that. April 18th is the day, the tax filing deadline. But for those of you who need to file an extension, you want to make sure you keep in alignment with that. And that date is October 18th. So, and make sure that you can actually do the extension. I know some folks who are not able to or on payment plans. So just make sure that you have all those dates so that you're in alignment. You're not having any penalty or in any trouble with the IRS. That is not the division to be in trouble with.
Definitely show them a little love, stay on top of your stuff. What I always tell people is the tax code is written for business owners. I know a lot of people who are doing great, make great income, who are W-2, regular, good working folks, but the tax code was not designed for them. So I'm going to just name off a couple of tax deductions that people should be doing if you're a business owner, or you should consider. But I always want to say this, make sure that you track all your receipts, your numbers, and how your expenses are going, because if these are a couple major ones that people forget. So the first one I want to talk about is travel expenses. My seat's going down a little bit on me, but it's travel expenses. So make sure you track your traveling while you're gone. We're talking about your flights, your food, your hotel, while you're traveling, because if you're going to a conference, if you ever go board meeting, a lot of this could be deductible for you. The second one is dining and food expenses. One thing that happened at first when Trump first did the new Trump tax plan, I always call it, was that the tax deduction for dining and food went down. But because of COVID, they made sure that it was 100% deductible because they wanted to promote business owners supporting restaurants who were hit the most during COVID. So your food and expenses during the period of COVID was deductible 100%. And I hope that they extend this beyond the COVID period. Also, there are great deductions for your auto, truck, and SUV deductions. This year, we're all crying about gas prices. But as a business owner, you are able to deduct your gas, your expenses for your vehicle, the parking, everything that goes along with it. The fourth thing is home office and home office supplies. So if you have a home office, you can deduct a percentage of your home that you're using for your home office and the office supplies that you need to run your business. Now, I'm not going to say everything I'm going to say for a home office, but if you think it's used for your business, use it as your home office supplies for it. And last but not least, technology and telephone. The good thing is with your cell phone, internet, computer, other things you might use for technology is also deductible for you as being a business owner.
Absolutely. And I'd just like to add, if you're someone who's having trouble keeping track of your expenses, I know, some folks are keeping their receipts in a place, and sometimes that can be a bit difficult. But if you have, let's say, a business credit card, business bank accounts where you can track all of these different things, it makes it a lot easier. Another way to do that is also to have a professional that you're working with, maybe a bookkeeper that can help you with these deductions and tracking your expenses. So just some ways to, maybe invest that time to do so. A lot of people say, well, I don't have enough to even invest in a bookkeeper, but that could end up saving you a lot of money as well. So you just want to make sure that you look at those options.
Yeah, and let me say this as well. I had a client yesterday. She was getting a lot of 1099s. She's a dental hygienist, and she didn't consider herself a business owner. But I tell anybody, if you're receiving 1099s, you're actually considered a business owner. So a lot of these deductions apply to you. So if you're getting 1099s and not just W-2s, look at these business deductions. And what I always told her was, you want to consider if you should do itemized deductions or what they call, or your standard deductions. If your itemized deductions are higher than your standard deductions, you should do that. But the only way you can do that is making sure that you categorize and keep receipts for all these deductions here, plus some. But we want to give you the 5 big ones that people miss out on that they definitely should take advantage of.
Absolutely. And make sure you're working with your tax professional. We are not tax professionals. We are just giving you the information right now, but we work in alignment with helping to construct some of the different plans that we're going to talk about further as well. So what are these different retirement plans or other things that you're talking about as far as ways that you can start not only contributing to your long-term retirement plans, but also being able to have some of the tax advantages? So one of the main questions that I also get is, what are the differences between a Roth and a traditional IRA? Now, the main difference is the tax advantages. So if you're looking at a traditional IRA, that's going to be your pre-tax versus a Roth, which is going to be after tax, and that's able to grow into that tax-free retirement. So the contribution limits you can see here are $6,000 a year. If you're over 50, they have what's called a catch-up. So it's $7,000, you get an additional $1,000 that you can contribute. And these are, again, if you look at some of the comparisons, a traditional IRA is tax deductible. With a Roth, you're going to see those tax-free withdrawals. So making sure that you're choosing the right one based on where you are as far as how much you need to maybe deduct, or if you just have some after tax that you'd like to see grow with your investments. So I think it's a great way to make sure that also you're within those limits when it comes to income and how you're working, whether you need the money on a long-term basis or it's something that you don't want to worry about. But these are just some ways that you can go ahead and do that. The other thing that I'll say is, if you are looking towards some of these retirement plans, you want to make sure that you're meeting those deadlines as well. Anything you'd like to add, Jason?
No, I think this is great. I want to just say is, and remember, you could do these all the way up until you file your taxes. So if you file your taxes on April 18th, you're going to make the contribution. As long as we have the check written out by April 18th, you can make the contributions to these accounts. So don't be like, oh man, it's our 2021 passed. It's too late. No, you can do this all the way until you file your taxes. So if you file an extension, you can do all these tax breaks, but make sure you talk to us and we can help you along that path. So next, we talked about the IRA, which is a $6,000 deduction. But the better one, if you're knocking the ball out the park, you need even more deductions than 6,000, is looking at a Sep Ira, which is designed for a small business owner who might be a 1 or 2 man per operation, and you need more than the $6,000 deduction. So how the Sep Ira works is the employer is the only one who can make contributions. They can make contributions up to 25% of the total net for the year. So let's say you make 100,000, you can put away $25,000, which now makes your taxable $75,000 of taxable income for the year. So now you just made yourself a lot less. It shows that you make a lot less income on that for yourself. And remember, you can contribute to that all the way up to April 18th, or if you file an extension until October 18th of this year for 2021.
Absolutely. And one thing I want to also make clear is even though you do have until April 18th, sometimes it does take time to set it up because everyone's trying to do it last minute. So you want to make sure you're doing that as soon as possible, just to give yourself enough time to maybe open the account, transfer funds, so that you're meeting all your deadlines. Yeah, go ahead.
And another thing I want to say is what I tell a lot of my clients is when you sit down with your tax person, before they hit that button for electronic filing, ask them, because I know a lot of people have their tax person might not bring it. Say, what is the max I could contribute towards my SEP, to my Sep Ira, and what is the benefits for me to do it? So they might say, hey, you owe blah, blah, blah amount. And you say, hey, what happens if I do a Sep Ira? They say, if you do a SEP, let me put in the number real quick. And they type it in, the max contribution, and it will say, hey, you saved this amount of money on your taxes. So that could be a great vehicle. And you say, hey, before you push that button, let me hear you call Jason or Thandiwe to set this up so I can make sure I get that tax deduction or get that tax deduction for the year.
That's a great point. I'm sure you've had clients who maybe you've over contributed to the Sep Ira, and then you end up having to go back, reverse things. So it's a lot of, you can do it, but it's a lot more trouble if you just make sure you check with your tax professional prior to making these contributions. It's a lot smoother process. But again, it goes back to making sure you have everything in order before that April 18th deadline. So if you haven't started already, you know, we're about to start April this week, make sure you get that done. So this is another, we're kind of going on you know, different levels of how much you're able to contribute to some of these plans. So the next level, let's say for an example, you have already contributed to your SEP. You're maybe thinking, okay, I need something more, or it's an option. This is a great way to make larger contributions. We've shown some of the advantages if we're comparing it to a Sep Ira. So you have larger contributions, like I said. This also allows you to take a loan, hardship withdrawals. So there's certain things that, you know, life happens. So if you do have to make withdrawals through your 401k plan, you are able to do that. Salary deferrals and catch-up provisions. So again, that allows you more if you are a little bit older and you're catching up. And then there is the Roth contribution, so the after-tax portion. Because a 401k is traditionally the tax-deferred side of it, you're also able to add a Roth, which is an after-tax contribution. So if you want some more ways to be able to contribute to that plan, you're able to do so. Do you want to go ahead and talk about this illustration that we have here?
Yeah, definitely. So what this illustration shows, especially for us people who are S Corp, the benefits of doing a 401k plan over a Sep Ira. The downfall of a Sep Ira is that on the employee side, we cannot make contributions on the employee side. So if you pay yourself a salary, let's look at the right-hand side where you see this person making $162,000 a year. For the Sep on the employee side, they cannot make any contribution on the employee side with the Sep Ira. But on the 401k plan, they could put $20,500 away. But on the employer side, they can still make the $40,500 of which is 25% of the employer contribution, and they can also do it for the 401k plan. Also, with the 401k plan, there's a catch-up contribution of $6,500, which the Sep Ira does not allow you to have. So with the Sep Ira, 95% of the time, you can make more of a contribution than the Sep. But the downfall of this is this. With the 401k plan, you had to open up the account before December 31st. I'm not saying you had to make contributions. The account had to be open before the end of the year.
No, that's a great point. And to add to that, you want to make sure this plan takes typically a little bit longer than it would if you're opening up a SEP IRA. So you want to make sure you have that time in between. It could take a couple weeks, it could take a couple months to open up. It just depends on the situation, but you want to make sure, let's say you're not able to do it for 2021, for 2022 this year, it's something that you want to start thinking about and setting up, because again, just that process in between could be a little bit longer than some of the other plans that the other options that we have displayed here today.
Yeah, and what I usually recommend for my clients who haven't is, hey, let's go ahead and do the SEP for 2021 tax year. Then as soon as we have the SEP founded, so we can make the contribution for 2021, then after that, we will set up the 401k plan. And so, yes, might be too late to do a 401k plan if you don't have it open, but at least we can do the best we can with the SEP for this year. And then 2022 going forward, we have the 401k plan as well. But next, we're going to talk about cash balance plans. People don't hear about cash balance plans, but let's say this is how I look at it. We have the IRA, which is the minimum contribution you could get for a tax deduction. Then you have the SEP, which is better than that, has more flexibility, but it does a lot more than the regular IRA for the small business owner. The following thing is the 401k plan, which means you can put even more money away. But then you have the souped up tax deduction. So this is designed for somebody who's knocking the ball out the park. Will we see this oftentimes are for medical and dental professional, my CPA, my attorney, my engineers, architects. I see this for my real estate agents who are killing it for them. And the reason that is when we do a cash balance plans, it is not based off a income limit like we have with the 401k plan and SEP. It's more based off of your age and your company's growth and your employee contributions. So you actually could put a lot more money away. So you look at this right here. We talked about with the 401k plan, the max contribution is $68,000. But with the cash balance plan, you see, if you look at the age of 35, you can put $150,000. If you're 45, you could put $200,000. If you're 55, you could put over $300,000 away. And if you're working at 65, which I know some business owners who do not plan on retiring, who's still making great money, they can deduct up to $400,000 away in the cash balance plan. Now, that money is tax deductible. That money is growing tax deferred. But the drawback is you have to be committed a few years for this plan. This is not for the flash in the pan, 15 seconds of fame person. This is for the business owner who says, hey, I'm going to be good. I need deductions for the next 5 years, because you have to be committed towards this plan for about 5 years or later. So this is for that person who know every year I'm consistently putting money away where I could deduct up to $150,000, $200,000, so on and so forth. Thandiwe, you want to speak more about this plan?
Absolutely. So besides just the industries that you were talking about that this could be a potential fit for, this plan is actually more advantageous the older that you are, allowing you to give a higher contribution limit. In addition to that, this is not the plan for if you're just trying to reduce your tax liability by a couple $1,000s. Typically, you're going to see this if it's over, I would say even 100,000, where this plan starts to make a little bit more sense. So like you said, if you're a real estate agent, you've had a great year. Let's say you're making $400,000, and you're like, okay, well, I don't know if I necessarily want to pay taxes on that. This is a great option when you've already kind of gone down the line of maxing out your 401k or your SEP IRA plans, and you want to make greater contributions. But like Jason said, you want to make sure that this is something that it's not just for this year. We're looking, let's say, even 5 to 10 years down the line of being able to maintain that. So just keep that in mind if this is a plan or if you think that you're a fit for this as well.
Great points, Thandiwe. Great points. Now, well, I will tell you this is cash balance plan is not something that you just go to the bank and say, hey, I want to open up a cash balance plan. This is a plan where you, like you could with a regular IRA. A cash balance plan is more where you want to talk to an expert and somebody who specializes in. Also, this is not for somebody who has a lot of employees. So and anybody has 30, 40, 50 employees, this might not be the plan for you. There might be some other strategies, but today we just want to give out some basic plans that we're seeing a lot of our clients are doing. As we work with a lot of people who are in real estate, we work with CPAs, we work with attorneys. So this could be definitely plans for you.
Absolutely. So we're gonna go ahead to. So I just want to talk about, some important tips that we went over to keep. So basically, a lot of these plans here are to keep more money in your pocket and out of the government's pocket. At the end of the day, we want to make sure these are legal strategies that you're using, but there are ways to go about it. Like Jason said earlier, a lot of these tax advantages are for business owners. It's not made for your typical W-2 earner. So you want to make sure your business is structured the right way, your plans are together, and you're also meeting those deadlines. So it's really, really important to make sure, if you are not already, working with a professional that's going to help you do so. So on the side of making sure that you have somebody that's able to walk you through, okay, this is what your tax liability could be, before they press that button, making sure that you're working with someone like even me or Jason to help you put those plans so that we can talk more strategy about that as well before those deadlines come up. So if you haven't already and you're sitting there and you're like, okay, these are something that I can see applying to my business, or I can make more deductions, then again, you want to make sure that you do that prior to April 18th and kind of give some time in between. But again, make sure you talk to your tax professional, and we'll kind of work together to make sure that happens.
Definitely. Now, if you guys want to give us a contact, you guys can contact us a couple of different ways. One, you guys can email us at matthewsfinancial@gmail.com, or give us a call at 510-943-2124. Do anybody have any questions about the topic at all that we mentioned? If you do, go ahead and put that in the chat, any questions you might ask. We give you guys a minute or two.
Great. And for anybody who registered via Eventbrite, we're also going to be sending out a link if you would like to have a further discussion with us. If you have any questions that are specific to you, we will also make sure we will send that out as well. But yes, please make sure you put questions in the chat. I'm going to go ahead and end share here. And before we start answering questions, I have a question for you, Jason. What would you say to a business owner who they haven't finished filing their taxes yet? They're looking for some different options. Any tips or anything that we didn't cover in today's workshop that you would like to let them know about before they go ahead and click that button?
Yeah, I say, even if I tell people, one of the biggest mistakes I see is people putting their head down because they didn't take care of their stuff. So they put their head down, they don't file an extension, and then next you know, you pay a hefty amount of penalties for it. I think the biggest thing that we could do is don't put your head down, ask for help and support, and make sure you file an extension. I know a lot of business owners who constantly do that, and you're paying tons of penalties and fees. But we could all avoid that if we just ask for help. Just don't feel like you're drowning as your own. I think a lot of business owners think they're doing everything themselves and not. Take that 6 months, get your team together, and then put together a plan. But do not put your head down and forget to file an extension, especially if you're a corporation, because the fastest way you can shut down your corporation, your business, is not by filing your taxes. So make sure you talk to somebody and build your team. Is one thing I always see. Yeah, that's the biggest thing I always see out there right now is people just too many people just put their head in the sand and just, oh my gosh, I'm scared to do taxes and everything, which is the worst thing you do. Show them a little bit of love.
You still have to do it. You definitely don't want to be behind and then the IRS is after you and trying to collect taxes. That's not a good situation to be in. But I really like that point that you made about having your team and making sure that, you're not all by yourself. You need to have your tax person, you need to have your financial advisor, your legal advocate, all these different things to help your business run smoothly. But again, this seminar is to really make you realize, if you have not sat down with somebody already, to make sure that you do that prior to April 18th so you can take advantage of some of the options that we talked about today. because it is made for business owners. So take advantage of it.
Right. And if you, let me say this as well. If you're a high income earner, I know a lot of people, especially in the Bay Area, who make great amount of income, but they're W-2 and W-2 employees. And you're like, man, this sucks. There's no deductions. I'm getting killed on taxes. I would highly recommend that you look at 2022 and figure out a hobby, a side business, or a hustle you can make money from, so you can take advantage of some of these tax deductions that are for you. We could all complain about something, but take it, which complaint does nothing. But we all could just start thinking about strategies that we could personally use to better ourselves. And one simple way is, if you can't beat them, join them. Start a business. Let it be a YouTube video. Let it be a travel business. Let it be a blog. I don't know what it could be, but think about a business that you could do for yourself and invest in that business, however that looks like, and take advantage of a lot of tax deductions that can be help out for you. But make sure it's legit. Don't make it not legit, but make it legit. Once again, we're not tax. We don't do taxes. Talk to your tax a professional, as we just give out strategies on what you could possibly do.
Absolutely. Well, with that said, we will go ahead and let everyone get back to their afternoon. Again, if you would like to contact us, please email us at matthewsfinancial@gmail.com or call us at 510-943-2124. All right. I hope everyone has a great afternoon. Thank you.
Thank you, everybody.